Welcome, investors. Today, we're going to discuss why we believe the inflation rate, let me preface the word rate, is coming down, and then what have the first quarter earnings report of some of the major retailers and publicly traded companies, what are they telling us? Let's get into it. All right, first, I want to talk about why I preface the word rate. Why do we believe the inflation rate is coming down when we go to the grocery store, when we go to the gasoline pump, and we still see prices extremely high? So let's use an example. A dozen eggs, beginning of 2023, let's just use $4. All right, you could buy a dozen eggs beginning of 2023 for $4. At the end of the year, the inflation rate was roughly 10%. So now, at the end of the year, that same dozen eggs are now costing you, the consumer, $4.40. Well, the inflation rate is coming down. Now, at the end of 2024, we can expect that same dozen eggs to be $4.53, which is roughly up another 3%. So the cost of the eggs, that dozen eggs, is still going up. It's just not going up the same momentum as it was a year prior. So, and people are still feeling the effects of rising prices. The only way that we're going to see prices come down is if we experience deflation, and when we experience deflation, we're really in a bad economic cycle, likely a recession. So why do we expect the inflation rate, now that you understand that, to come down? GDP was just released and revised for the first quarter. U.S. economy grew 1.3% in the first quarter as consumer spending slowed. So the economy grew at a slower rate than expected. It was reported that GDP for the first quarter was 1.6. Instead, we only got 1.3. And where was that drawdown? Consumer spending. Consumer spending shows signs of weakness. Consumer spending rose 0.2% last month before inflation is taken into account, but after factoring in inflation, spending actually fell. Most of the increase in spending was devoted to necessities such as rent, utilities, medical care, gas, and insurance. So consumers are still spending, but they're spending their money not on discretionary items, so computers, cars, your laptops, apparel, your clothes. They're not spending as much on those items. They're shifting towards absolute necessities, things that they can't live without: rent, your car insurance, your homeowner's insurance. And one other sign that deflation rate is indeed coming down, which could lead to actually coming down, not just the rate, but inflation and prices altogether, is we have major retailers, Walmart, Target, and then McDonald's, among a slew of other retailers, promising steep summer price cuts as food inflation bites consumers. So these companies are realizing that consumers are spending a much less on, again, the apparel, washer dryers, things they don't necessarily need. So the retailers are going to have to meet them. They can't keep prices high. They have to bring it down to spur consumers to keep spending. And we can see what the trend is of the consumer spending by looking at retail sales. So that's you and I going to the grocery store, going to Target, Walmart to purchase goods that we need for either a necessity or we need for just, I want a new shirt, I want a new suit, I want a new pair of shoes. So we can see is this retail sales over the last year, what is it doing? I mean, you can clearly see that people are slowing down their spending. And this is not even adjusted for inflation. So, retail sales likely are negative right now. People are spending significantly less. And I mean, you hear the headlines that, hey, we're stuck at this inflation, 3% right now. It's taken a long time to come down. Well, these big changes do take a long time to materialize, but we can all see the trend clearly right now. And again, this is a chart of inflation rate, personal consumer expenditures. That trend is on its way down, and it just takes some time to fully play out. With the elevated interest rates are taking a long time to feel the ramifications and feel the effects because the government pumps so much money in the system into people's pockets that it's just starting to wear out. However, people's habits are ingrained, so they're still trying to spend. They're using every means necessary to spend, and they're not saving any money. They're not building up their savings. They're spending. They're spending on with any savings that they have, and now they're moving to credit cards. And we'll take a look at credit cards in just a moment. So take a look at this. Americans aren't saving right now. The saving rate in April stayed at 3.6% and remained near the lowest levels since 2007-2009 recession, suggesting that Americans have less cushion to spend. So they're still spending. How are they spending? How are we seeing any retail sales? How are we seeing any consumer expenditures? And we can clearly see it's households. Debt climbs to $17.69 trillion for the first quarter, and delinquencies rates rise again. I mean, just look at this rate of debt. We are taking on a large amount of debt, credit card, high interest mortgage payments. We are just, again, it takes a long time to play out. And those interest payments are significantly higher than they were a year or 2 years ago. So people are feeling the crunch, and they're feeling it in their pocketbooks, and that credit card interest payment, I mean, the national average is up 20+%. It's difficult to maintain the spending. That's why we're seeing the debt rack up, because it's interest and the continued spending with no savings in the bank. All right, the last thing that I want to touch on, what have we been seeing from these earnings reports so far this year? And I want to specifically highlight a lot of the retailers like Best Buy, Costco, Walmart, Target, and there's a similar theme happening right now. And it is there's two line items to earnings reports. You have your top line, which is your revenue, your sales, and then the bottom line, which is your actual earnings, what the net profit was of your business. The top of line cannot be manipulated. You can't cut costs to get a higher top of line. So we're seeing right now these companies missing their top of line, so missing their revenue, missing their sales number, because people are slowing down their spending. However, they're beating on their bottom line. You want to know why? It's because they're cutting costs for goods, for labor, for services, and that's how they're beating that bottom line, and they have a fiduciary responsibility to their shareholders to do so.